We are now live streaming.
Let them in.
Everyone's here.
Oh, excellent, excellent.
Anthony has his hand raised, or did.
Oh, yeah, I was just saying hi.
Okay.
Christine,
So-
did you mute them?
Everyone should be coming in muted.
Okay.
Okay. So, Christine, you can take the graphic down. Let me see if I can do that. I can stop the share. Okay, good.
There you go.
Oh. Well, this is our favorite time of of these Zoom calls. Just seeing everybody jump on, and I'm seeing folks that we know. It's just great to see you. Lots of folks that have been here before, other people that are joining. We'll get started in just a few seconds as people still continue to join. Carl, let's, if you can kind of do a soft open.
Okay, well, welcome everybody to the May meeting of NWSOFA's Fiscal and Economic Issues Group. Your hosts are myself, Carl Falstick, and David Doney. And Bill is our chapter lead, who's going to give you guys an intro into what the heck is NWSOFA.
All right, let me bring up some slides here for your viewing enjoyment. There we go. In a couple seconds, you should be able to see something here. All right. Carl, let me know if you can see the title slide.
I can.
Okay, great. Well, welcome everybody to NWSOFA. Now, that stands for Northwest Suburbs Organizing for Action. And as you can see by the city view here, we're started in the northwest suburbs of Chicago, and we are an indivisible chapter. So we are one of 27, almost 2,800 chapters across the country. Indivisible has chapters that are growing basically 3 to 4 per day. And I don't think there's a state out there that doesn't have 3 or 4 in it. Today, we have our fiscal and economic May meeting. It's been going on for 13 years, almost 14 years running. And we hope that you enjoy it. Our goal is to organize and educate our members. And we believe that if you understand the facts, you can present your arguments sharper, cleaner, and you can communicate with your audience, whether it is a person that you're having a cup of coffee with, or it's around a family Thanksgiving dinner, or in a meeting. It's different ways that you can present information that does not create controversy, hopefully. So we are organized on the twin snowflake principle. On the left-hand side, you'll see about 22 different ways that we communicate, send emails, texts, do things on Facebook, on social media. And then the right-hand side is 19 of our issue teams that present almost every month. Now, just to give you an idea of the growth of this organization, we started back in 2012, right after Barack Obama won his second term. We had 17 members. This last year, we produced over 600 Zoom and in-person events. We're expecting to do 650 to 7 this year. We have 13,000 members in the Northwest burbs of Chicagoland. That's the area beyond O'Hare where we first started, and 26,000 Zoom members across the U.S. And to manage all this, we have 20 or 30 all volunteer leads. We like to call this as our secret sauce. And these days, we also have another 20, what we call our bench, people who are producing events and helping with events, waiting to become part of the core membership team. Just to give you a little idea of what we do every week, every morning through Monday through Friday at 9 a.m., we do a coffee and conversation. Every Friday, we do an unhappy happy hour at 5 o'clock. We do programs such as sharing our story monthly, when the president stops being abstract, how different disinformation has changed. We've done programs on people who are being detained. We have 2 groups every week that do what's called sorting soup, keying on the most current events of the afternoon every Thursday at 5, and then every Sunday at 4, they do a book club. We do phone banks, and we have social media storms, lots of things. So during this presentation tonight, we're asking you to put your questions in chat, but start your question with a big questions all in caps so we can find it. During the breaks in the meetings, we'll get a chance to address some of those questions. And David and Carl will answer some of those questions during the chat. So it's always kind of neat. And then at the very end, we'll do an open question and answers. So thank you all for being here. Carl and David, it is all yours. See, we still have people joining us.
We do.
And Carl is starting his screen now.
In any case, again, welcome everybody to our May meeting of the Fiscal and Economic Issues Group. I'm Carl Fulstick. My co-lead for this presentation is David Doney. And we'll try and educate you a little bit about what's happening. All right, let me go back to the beginning of the presentation. So anyhow, and there should be a link to the presentation, the PowerPoint presentation in the chat. And if you joined after I put it in, we'll put it back in the chat again later throughout the meeting. Anyhow, start with an economic overview, then we'll do the labor market, inflation, GDP growth, economic inequality or income inequality, and then other measures. So what's going well? Since President Trump took office, wages are up 4.7% and prices are up 4.2%. So that's not bad. Stock prices are up 22%, although only up about 8% so far this year. That's still not bad. We had near record real net worth for the bottom 50% last quarter. And real median household income in 2024 was a record. And that may or may not carry into 2025. We're hoping it does. What we have not so well, job creation has dropped quite a bit. Until the last 2 months, it had almost been stagnant since last April. And it's a combination of lower demand, reduced labor supply due to immigration restrictions, firing of federal workers, as well as, folks, getting old and retiring because their stocks went up and they figure they can get away with it. So we have 508,000 more people unemployed than when Trump took office. And from the household survey, we have 1.2 million fewer people employed than when Trump took office. So we've added some jobs, payroll jobs, in the establishment survey, but the household survey says that fewer people are employed, which makes some sense if you figure that we've lost a lot of people to deportations. The unemployment rate is 4.3%, which is up 0.3% from January, but it's still a pretty low number. Price levels have been going up significantly recently, February to April, due to the Iran war and especially the higher gas prices. The national average was $4.52 on May 16th, which was Saturday. I think it's about that today. The Illinois average is closer to 5, and Chicago Metro and Chicago City are substantially higher. And the Fed's preferred inflation measure, which is core PCE inflation, was 3.2% in March. And they have a 2% target on that. So we'll have to see what happens to it as to whether or not the Fed feels that they can get away with lowering the interest rates or whether they're going to have to raise the interest rate to fight inflation. So we have Trump's economic promises, and he was going to lower food prices on day one, which hasn't happened. He was going to lower gas prices. And they basically held pretty even from when he took office until just before Thanksgiving. A week before Thanksgiving, they started dropping. And then with the invasion of Iran and the bombing of Iran, they've gone up significantly. So they're up about $1.40, $1.50 versus prior to the war. He was going to lower energy costs, which hasn't happened. The only good electricity prices are up. The only good news is that natural gas prices have held fairly steady. So if you heated your house with natural gas this winter, you're probably okay. If you have electric heat and you'll have electric air conditioning, those prices are going to go up. He was going to revive the auto industry, and through March, auto sales were up. On the other hand, manufacturing jobs are down since he took office. Stock market has gone up. He was going to cut the debt with tariffs, and I think the deficit was down slightly in fiscal year 2025, but it's not looking, in my view, it's not looking like we're going to have the deficit go down in 2026. And we were supposed to lower the trade deficit, but that's not really happening either to any great extent. And one of the big things, the big economic legislation last year was the so-called One Big Beautiful Bill Act, which some people, the One Big Ugly Bill, but it basically said, if you are in the highest quintiles, you got a benefit from this in your after-tax income. If you are in the two lowest quintiles, the 40% lowest income levels, you actually got your after-tax income cut. So, but hey, the millionaires and billionaires are doing well, so we should be happy, right? No. The other thing that's not included in these numbers is that the enhanced subsidies on ACA exchanges expired at the end of 2025. So the average ACA out-of-pocket premium costs are going up around $900 on average to $1,900. The other thing I think I was reading today that about 1 million fewer people signed up for the ACA exchanges this year, but they're expecting to have a lot more drop out because of the higher costs. So labor market and the monthly jobs report, which is typically the first Friday of the month. Unless the first Friday is the first, in which case it doesn't always happen. But it's probably one of the most important things in terms of economic news releases. And historically, we needed to add about 100 to 150,000 jobs to get steady as we go. We're adding a lot fewer jobs, but we're still keeping the unemployment rate fairly steady because again, net immigration is negative, and so the unemployment rate can stay low on fewer job gains. Okay, so if we look at jobs, and again, this is pre-pandemic, so it doesn't cover the full Trump's first term, but we see that in February to April of 2020, there was a loss of 22 million payroll jobs versus the peak in February. Since then, we've had recovery through the end of Trump's term. First term, except for December for whatever reason. Then we had a recovery through Biden's term. And since Trump took office again, payroll jobs have been relatively flat. So if we look at the monthly job creation, along with the bars are the monthly numbers, the line is 3-month averages, we see that back in 2023, we had pretty good average job creation, but it was declining. And then actually grew in the second half of 2024. And then when President Trump took office, it started to decline, and we've had some negative months this year. So the 3-month average for the last 3 months under Trump, even with 2 good months, was plus 48,000. And where are we getting these jobs? Healthcare and social assistance is the big area, leisure and hospitality. Few more in construction. And you'll see that we get to, and again, this is from when he took office to the most recent last month. We see that a whole lot of job categories are negative, including manufacturing, which he was going to try and bring back. And government jobs as a whole have dropped. A lot of that has to do with federal government jobs dropping. So if we look at, and again, this is payroll jobs from the establishment survey, surveying companies, we see that in Obama's second term, we added 10 million jobs. In Trump's first term, we lost 2.7 million jobs. In Biden's term, we added 15 million jobs. So far under Trump's second term, we've added 468,000 jobs. And so the net total from Trump's first and second presidencies is we've lost almost 2.3 million payroll jobs under Trump. And this is a favorite one from Democrats that since the end of the Cold War, which I think does not include the first President Bush, but it could, we see that, and this was through March, we see that under Democratic presidents, we've added 50 million jobs. Under Republican presidents, we've added 1 million jobs. A lot of it has to do with the fact that job growth under the second President Bush was low, and job growth under President Trump has been negative. Now, there's also a household survey where they call it 50 to 60,000 households every month. And that's how we get things like the unemployment rate. And the U3 unemployment rate is what's typically reported. And to be counted in the unemployed in the U3, the person has to have looked for work actively in the past month, be available for work, and not have worked. So if they worked even a few hours, they'd be a part-time worker and would not be counted as unemployed. And we see the unemployment rate actually went down pretty well under Trump until we got to the pandemic. It exploded. It came down under Trump. So in Trump's first term, it went from 4.7% when he took office to 6.4% when he left office. When Biden left office, we were at 4%. And we're now at 4.3%. So it's up just a little bit under Trump's second term. But in Trump's second term, we've added 508,000 new unemployed. And so again, if we look at the household survey, we see that population grew, but the people in the labor force has shrunk. The participation rate has shrunk, although the overall participation rate has been shrinking for decades and decades and decades. The number of people employed shrunk, which is a new thing. So the employment to population ratio shrunk, the number of unemployed grew, and the not in the labor force grew substantially. So people who are not in the labor force are people like me who are retired, people who are in school, caregivers, disabled, housewives, whatever. Oh, and employed is wider than jobs. So there's more people employed than there are payroll jobs because it includes agriculture and the self-employed. Your Uber and Lyft drivers, your DoorDash, and all those kind of good people are counted as employed here, but they don't have payroll jobs. So if you look at cumulative changes in jobs and employment under Trump's second term. We see that payroll jobs have grown a little bit, and the number of people employed basically stayed relatively, went dipped and then came back, but then since November has fallen off substantially. So again, if we look at the change in employment, from the household survey in Obama's second term, we added 8.8 more people employed. In Trump's first term, we lost 2.3 million people employed. In Biden's term, we added 14 million. In Trump's second term so far, we've lost 1.2 million employed. And so the cumulative under Trump is a loss of 3.5 million people counted as employed. Now, the employment population ratio for prime age workers is relatively stable, other than during the pandemic and the recovery from the pandemic. The number of people unemployed versus the jobs. We have right now a little fewer than one open job for every person that's unemployed. And of course, the problem is that not all the jobs are in places where it's convenient for somebody to work. If the job is in North Dakota, that doesn't do somebody in Chicago much good if their spouse is in Chicago. So anyhow, let's take a little bit of a break here and take questions on the labor market.
Oh, I don't know if it's specific to this, but I can read off what I have.
Okay.
Okay, I know some will be answered in the GDP, so we will go to Lynn, who is asking a few questions. Her first one is, do you work with NIBCcoalition.org, which is the National Infrastructure Bankers Group that set up nonprofit banking systems?
I don't.
Okay. Second one is asking similarly, do you work with nextcities.org and civicaction.org that our library started?
I don't.
Okay. Question 3, do you work with pro bono lawyers for good government and pogo.org?
Not sure what that would be in reference to, but I don't.
Okay. That answers those 3. And then she has another question. Are you aware of Patrick Wood technocracy news and trends warning about all the monies going for data centers and the takeover by evil oligarchs with their citizen robots like Sophia and their humanoid super soldiers in Project 2025, and all tied to illegal wars, human trafficking, ICE, detention centers, jails, and genocide tied to massive depopulation agenda for total control of humans?
That is an awesome movie plot.
It is.
I want to see that one in
Science fiction.
let's hope we don't get the Terminator super soldier
There you go.
scenario. But I mean, if you think about where AI is going down the road, at some point the militaries are using drones now. The war has gotten so lethal for soldiers that they basically have to hide underground because the drones are sort of controlling the airspace, the ground space in the Ukraine and Russia war to a large extent. And they use robots on the ground. There's all kinds of interesting things going on with drones. So they might not be humanoid super soldiers, but there's going to be plenty of non-humanoid super soldiers floating around if over time. So we did some pretty heavy duty stuff with AI a few months back, and we're probably due for another one. we'll talk a little bit about it in the GDP section in terms of you're seeing a lot of investment going into AI itself, the idea of creating the models and all that, and you're seeing a lot of it in the equipment that's going into data centers. But actually, and Carl will share this with you in a minute, is the structures, the investment in structures was actually down a little bit in the past quarter. That wasn't driving the GDP the way that it was more recently when a lot of these structures are being built. But there's still plenty being built. It just wasn't driving the GDP. It wasn't accelerating. But there is a lot going on inside the data centers, companies that all those giant rooms full of servers and other gear that goes inside of a data center, the optic cable, all that stuff is just going crazy. There was a giant increase in the amount of investing in that space, and the stocks that are related to that have been going through the roof until the last couple of days. So we'll talk about that a little more in the GDP.
Well,
Okay,
thank
I
you,
just
gentlemen.
dropped a link to the PowerPoint presentation for anybody who wants to follow along at home or refer back to it in the future.
That is it at this time.
Okay, and we're going to switch to inflation. So, David, do you want to share your screen for this?
Sure. Let me go there.
I'll stop sharing and you can share.
All right.
Because with gas prices going up, inflation is all of a sudden a much bigger factor than it was last year,
Right.
prior to the Iran war.
Sure is. Carl, can you see the full screen?
Yes.
All right. So we'll talk inflation for a little bit. The gas prices are what's driving it right now, although there were some other categories that did jump this past month. So it wasn't just gas prices. Most of the gas prices are probably now reflected in the inflation. We'll see probably the rest of it next month. So it's probably not going to be as big a driver of inflation as it was the last 2 months, but it'll still push it up a little bit more. So yeah, Carl was saying earlier, the gas prices are about $4.50 nationally. They're up about 45% since Trump started. And you can always get the latest. Just go, if you type AAA gas prices into a browser window, you'll get a good, credible source that'll tell you exactly where gas prices are all over the country. The AAA has a nice site for that. So how much money does that mean for a family? When you say gas prices are up $1, what does that really mean? So the estimate from our AI friend here is about $1,000 a household. If you think some people with older kids have 3 cars in the driveway, they're all driving around, using 20 gallons a week. This $1 higher gas price would be $1,000 if you use that math. And if you are up $1.50 or so, then that would probably be $1,500 for a household. Now, understand this is just at the pump. This doesn't include the fact that transportation costs are going to add cost to every product. Everything is transported. That's why people watch the diesel prices as well, because that's the trucks that are driving everything all over the place. We don't have it in here, but I believe the diesel prices have gone up even more. So this is just the narrow version. Is Trump has made it $1,000 or $1,500, almost $1,500 a household more expensive just in terms of what you're paying at the pump. You can look at the broader inflation numbers for other impact, but it's really useful when you're talking in economic numbers to try to explain it in terms that make sense for a pocketbook. And so here's one example of that. The last 2 months, the price level has jumped a lot. So this is the price level relative to the month before. So in March, the price level went up by almost 1%. Overall, because of gas is such a big deal, and some of the other inflation, the price level in the US went up almost 1% in just that month. And it was 0.6 in April. And so that's where we talked about earlier, the price level's up about 1.5% since February. That's just 2 months of that. The way people usually report the inflation is versus a year ago. And so that blue line has just taken off. The red line is the core, and so that doesn't include food or energy. And food hasn't gone crazy, but although it did pop last month, but the energy prices have gone nuts, and so you're not seeing that in the red line because that's the core. It excludes food and energy from the math, and this is the CPE, but Carl mentioned earlier the Fed uses a PCE measure. They use a PCE core measure, so they're not going to see they're going to sort of disregard the gas prices as they think of that as something that fluctuates up and down. Let's hope that they're right about that the gas price does fall back once we end hostilities, hopefully sooner rather than later. This is the categories versus a year ago. So 3.8% is the CPI increase versus a year ago. That's this blue line here, 3.8. That's the 3.8 up here at the top, and here's all the parts of it. And CNBC does this nice article every month. Here's the breakdown for this month. So if you're ever curious, just do a search on that and you get this nice chart that tells you where the action is. But food, it hasn't been the crazy one, 3% since over the last year. There are some categories of food like fruits and veggies that are up, but the energy has been the story. And energy, of course, the airline fares are going to follow that because they bump up their prices for the fuel costs. It's not on the, oops, sorry. Let's see, where do we have here? Rent of the primary residence. This is another one that's very heavily weighted. That one has not been too bad over the past year. So it's really, right now, it's a gas price story. When Trump started, inflation was about 3% and falling. And now that he put in the tariffs, that started going up. And then we had this break because of the shutdown. And so there was some drama around the way we compute the inflation rate. And so we've been sort of waiting for that to work itself out. It's very technical. I don't even fully understand it. And it had to do with something with the way the real estate was handled. But now the inflation rate's all the way up to 3.8 and rising. So he starts, it's at 3, falling. Now it's at 3.8 and rising. So there's been a lot of spin control on social media by different spokespeople for Trump. Different politicians are all trying to get away from this story, saying, but look over here, Biden had 9% inflation at one point. And remember, that inflation was global. And the gas prices went up almost $1 around the time that Putin invaded Ukraine, that Russia invaded Ukraine. So Biden was facing a global situation and action by Putin, whereas Trump, this is entirely self-inflicted. None of this would have happened without the tariffs and without the attack on Iran. It's 100% on Trump. We might be already very close to that 2.5 range here in the CPI, which would translate to about a 2% target rate of inflation. The Fed could have declared victory. I'm sure the Fed chair, who's on his way out or has just been gone, is pissed off because he would have been able to declare victory and say, I got us back down to target. You know, we had the soft landing that we said we were going to deliver, and Trump threw a wrench in that. This is the Fed's preferred measure, and it's reported late in the month, so we've got it back to March. So this does not reflect really what we saw in April. So there's going to be another jump in these numbers, but they look at the PCE core. Either way, though, since Trump started, they're both up. Both of these measures, the PCE all, the PCE core, are up. Part of why the Fed likes this measure better is it reflects substitution better, meaning if you are buying, if the price of, let's say, steak or hamburger goes way up, you can switch to chicken. Hopefully chicken has not gone up as much. So that idea is reflected in here, and it's part of why they like this measure a little bit better. But the media, for the most part, does CPI, and that's why we've talked about that up to this point. The good news is, if you go back to before the pandemic, wages cumulatively have outgrown inflation. Now, a lot of people don't believe that. And they say, well, it doesn't apply to me. And, you know, we've talked about this many times about how even the Congressional Budget Office has said, yes, it does apply to you. The wage gains at the bottom of the spectrum, the income spectrum, were faster than at the top during much of the Biden era. So either way, though, since February of 2020, which is sort of the last pre-pandemic month, at no time did we have less purchasing power overall than we had in 2019. And people love 2019. Allegedly, that's where Trump sort of built his brand of being an economic savant, was in 2019, and how awesome the economy was before the pandemic. And well, wages have outgrown inflation since then. We have more purchasing power now, and did throughout the Biden era, than we had in 2019. This is the real wage. So this is adjusted for inflation, dollars per hour. And the last 2 months, it's actually fallen because inflation has been so high, 0.9 one month, 0.6 the other month. Wage gains are usually in like the 0.2 to 0.4 range. So the real wage, the purchasing power, has fallen the last 2 months. That's what you see over here, but it's still extremely high historically. And this peak here, you can disregard. That's a statistical aberration. There's a note here explains what happened. But for the most part, going back and comparing against where we were before the pandemic, we've always had a higher real wage than there. And this is the production and non-supervisory workers. So this is the bottom 80% of the distribution. This number is not distorted by the high income people, the salary high income people. This is the hourly workers, which are about 80% of the workforce. So they're doing okay. If you look at Trump, you look at the cumulative gains in different financial measures since Trump started. So these are averages, the average in January 2025 versus the average in April of 2026. So that's why the stock number is 16 and not 22. It's average to average. And that's generally how the monthly statistics are reported, as the observation for that month. So gas prices 33% up, stock 16.3%, electricity 8.7, etc. The good news is the hourly wages up 4.7, inflation, CPI all up 4.2, meaning we have more purchasing power than when Trump started. Despite all the news about inflation, wages, there's some cushion there. The wages have outgrown the inflation up to this point. We'll see if that's true or not over time. As I mentioned, the real wage has fallen in the last couple of months. So that means that these numbers are getting closer together. And so in a couple of months, we'll see if, wouldn't surprise me if the wages like next month might be, let's say 5% cumulatively up. The inflation might be 4.7 or 4.8. So instead of being 0.5 apart, they may be only 0.2 or 0.3 apart next month. We'll see what happens there. But rent and groceries, I mean, almost everything goes up. I've said it here before. Since 1947, which is how long we have the CPI data going back, since 1947, there have only been 3 years when the price level overall fell. Usually it's at the tail end of a recession when things are bad and there's a lot of unemployment. And of those 3 drops, the largest one of any of them was 1%. And that was in 1949. So in other words, when a politician says, I'm going to lower prices, they are always lying to you. Prices do not go down overall. It doesn't happen. It's not a thing. All right. So the question is, what's going on with the real wage? And people may have been upset when the real wage was falling as inflation was accelerating under Biden, but we always had more purchasing power than 2019 and all those years before. In fact, not in this presentation, but on average, this plateau under Biden, way up high here near the all-time record level, Biden had the highest real wage on average among the last 11 presidents. So the real wage has been very high. And this is why, and one of the many reasons why the economy keeps surprising people. They're like, we're going into recession. It's the end of the world. It's like, no, the real wages are near all-time record level. People are doing okay. It's always somebody else that's suffering. So beware the affordability narrative. Of course, there's always people left behind, but it's not going to show up in a lot of the aggregates. Things look pretty good in terms of the household finances. This is the personal savings rate, which is falling. And it was 5.1% when Trump started, and now it's 3.6. But the reason may surprise you. You may think it's because, well, there's more inflation or things are more expensive, and so people can't save as much. But when you adjust this for inflation, what you see is that people are buying more stuff. They may be anxiety purchases. They may be nervous about what's going on, but people are buying more stuff than they used to. Instead of having 4 jackets, they've got 6. Instead of having 3 pairs of shoes, they've got 5 or 7. You know, people are instead of 1 television, houses have 4 now. I mean, this is what people are doing is they have been spending, and that has been keeping this economy moving along as well as it has been moving. So it's not, don't think of it just as people just don't have any money left over at the end of the day. It's just, that's part of it, but most of it is really buying more stuff.
Well,
The interest rates and mortgage rates are jumping since this Iran thing, and this is a very big part of the story of what's going on. So and this is why the stock market is supposed to mechanically fall. If you have interest rates rising, asset prices like houses and stocks are supposed to fall. And so even though it had been falling for much of the Trump administration since the attack on Iran down here around the time that it hit the bottom, those mortgage rates are up. All the treasury bond interest rates are up. So up, and the numbers are up here in the corner. The 30 years up, you know, 1/3 of a point. The 10 years up almost half. The 3 years up more than half. So this is hoping that inflation will get back down over the longer run, which is why the longer run number is smaller than the short run number. But what this is saying is that investors are demanding compensation for what they perceive to be as higher inflation. They are expecting higher inflation, and they're saying, I want a better return. If you're gonna auction a bond, Uncle Sam, I want a higher interest rate on it. And that's what we're starting to see. What this will do is should put a dampener on the stock market. It should also lower home prices, although home prices tend to be very sticky. People don't like to give up their house. And related to the same idea, the Fed really watches carefully investor inflation expectations, and they can see it in near real time because you can see how a bond that is inflation protected and one that is regular relate to each other. And so the inflation protected bonds have a lower interest rate than the unprotected or the regular bonds. And you can see these amounts have been going up. So whereas let's see, this is the 5-year. So an investor who wants to buy a 5-year treasury bond was saying, I want 2.5%. I'm expecting 2.5% inflation. Now that's like 2.7. And the same idea here with the 10-year. And these are built into these interest rates in the bonds. Not the exact same bond, but that's that idea of expectations of future inflation going up. The Fed really does not like to see that. And this tells you really that the more of this you see, the more likely it is that the Fed is going to possibly even raise interest rates the next time. Trump's guy, that's the new Fed chair, is not going to want to do that, but he's only got 1 vote on the group that makes that decision. So it'll be interesting to see what the Fed does in their next meeting facing this kind of inflation. If they a lot more of them want to try to raise the rate rather than lower it, because they do not want to let this cat out of the bag. Let me pause there. Let's take a look. And Carl, you've probably been looking at the chat, and Debbie, you can help us with questions.
I don't, let's see here. Let me get back to my email here. Don't have a lot, but I will give you the ones that I have. Jacqueline is asking how much of the price increases will be baked in when hopefully the war of choice settles out.
That's a great question. I would expect that the price of most stuff, prices don't fall. So overall,
gas prices will fall
gas will
next year than this year.
Yeah. Gas prices will fall. It is possible, I guess, Carl, it's possible that we could have, if we had a big drop in inflation, in the gas prices, that you could see a couple of months of negative overall inflation. You could have a month or two that are like minus 0.1, the price level drops. But the chances are the price level, everything else that's already up is not going to move. It's just that gas price that is doing it.
Right.
So they tend to be sticky. Let's put it that way. Once those prices go up, don't expect them to come back down overall. Just those individual commodity groups like egg prices go up and down. Gas prices go up and down.
Yeah. I mean, Jewel had a dozen eggs for 49 cents this past week.
Ooh, watch out. All right. Mark has a
Well,
question for
supplies
you.
last, so I don't although the sales goes through whenever your Jewel closes tonight, they probably don't have any left.
This is true.
But they did have ground beef quarter pound patties for $4 a pound, which
Wow.
is not bad for ground beef these days.
Right. So Mark's question is, there are serious implications on oil supply, refinery issues coming in June, with very serious further implications by September if we don't address this. Any comments?
I haven't studied that issue yet, but it is a big deal. The oil sort of inventories around the world are getting drawn down. We covered last month that the U.S. has stepped into the breach a little bit and is exporting a couple million more barrels a day than we used to. So that is not typical. We are actually sort of helping mitigate the problem that we've been creating. We are sending a lot of oil overseas now. So trying to get my brain around that has been challenging. So we'll see, but I think it's definitely something coming up. It's something we'll have to cover, and I think we're going to see a lot more of it in the news if the hostilities cease and they somehow get to a ceasefire. But because there's been this disruption, and you might see this oil price be high for quite some time, especially if countries all over the world start trying to rebuild their inventory level. Then you're going to see a lot of demand for oil, and those prices may stay up even after the U.S. stops the attacks and convinces our friend Israel to stop the attacks. It could definitely last for a while. I would not expect gas prices to fall much below $4 this year. They'll probably come down a ways, but I wouldn't expect to see $3 and $2 gas this year.
Nowhere near.
I hope I'm wrong, but we'll see.
All right. Jacqueline has another question for you. Any research on what inflation and economy would be if Trump had just followed Biden economy without tariffs and war?
Yeah. It's inflation would probably be about 2%. The PCE inflation would probably be right around the Fed target. The studies I saw coming out of the Fed are that the tariffs added about 0.8 to inflation, about 0.8, so not quite a percentage point. And once those happen, they're sticky, so those prices aren't going to come down. And that's the big one. So if we look at, let me go back up a little bit here real quick. If this is PCE inflation, and the 3.5 would be more like minus 0.7, that would be more like 2.8. And this one, 3.2, would be more like 2.4. And bear in mind, this not so much the lower one, but the upper one has been impacted by the gas prices. But if you look at the core and you take out the tariffs, 0.8, that's about where we'd be. I think that's a good back of the envelope estimate of where we are. That would be 2.4, very close to the Fed target.
Okay. Dee has a question for you. Would DJT not be angry if the new Fed officer raised interest rates?
The Fed officer won't, but the Fed might raise them. And that is not a crazy thing to do when you've got inflation expectations rising. The Fed wants to see that flatten out or go down. And they will, in theory, they should be raising rates to deal with that. Now, keep in mind, though, the Fed is kind of what's the right way to say it? They are the tail here, not the dog. Because look at this, the interest rates have already climbed, right? The 30-year, the 10-year, and the 3-year are already up. So it's not a question of, is the Fed if the Fed raises their interest rate, it's not like these numbers are going to just suddenly jump again. The short-term numbers may move up a little bit, but the long-term, the 30-year, the mortgage rate, they've already priced this in kind of to a significant extent. So the Fed will be lagging here and not leading if they raise their rates. The markets have already reacted to this.
Right.
To a great extent.
Definitely. Okay. Chris has a question. Is only looking at real wages and inflation a good metric to determine affordability? And then she doesn't go into why she is asking that. So
I usually get in trouble on this subject, as those of you that have been on here know, because it's not a popular point of view. What I will tell you, and I use this as my main data point on this, the Congressional Budget Office did a report, they put it out in 2024, and they said that all income quintiles, so the bottom 20% poorest, all the way to the 20% richest, all had more purchasing power in 2023 than 2019. And that continued toward the end of the Biden administration, meaning there's no reason to think that CBO wouldn't come to a different answer if they looked at 2024 or 2025 versus 2019. So that the key thing there is you can argue, okay, the real wage, that's an average, even though it's the bottom 80%, that leaves too many out. CBO said, no, every quintile was better off. And that's the data point I use because CBO is the most credible source of information you can get on this sort of thing. And so I look at it as, yes, there are people suffering. Yes, some people are in circumstances where inflation is hitting them harder than others. If you rent, if you were forced to buy a big pickup truck as part of your job, if you drive long distances in a rural area as part of that, that all those inflation things sort of hit you. If you are a city dweller who owns your condo and you walk everywhere, you're just thrilled that the house prices went up. So it just depends on where you're at. But the CBO is the measure that I weigh the most heavily here, saying all the groups were better off than 2019 when affordability was not a headline. It was not something that everybody talked about. And understand I'm a progressive who wants to raise taxes on rich people and pay for healthcare, pay for higher education, do all that. But I can't use the data to make that argument because this data is actually pretty darn good. I'll make the argument anyway. I just don't have the data to say there's a burning platform that we need to radically overhaul. Makes it harder. I wish there were some days. It's not.
Well, obviously, the last couple of months have the high inflation,
Right.
and so we've got a decline in real wages.
That's right. This number's been coming down, but it's still extremely high historically.
And the other thing is that, while the group as a whole may be doing well, there are still many people within the group that are not. I mean, if you look at the increase in unemployment of 500,000 people, that is, those people that are unemployed are not going to be winning.
Right. Yep.
So there's large groups of people that are not winning, even though overall most people are, if that makes any sense.
Yeah. Yeah. Carl, you want me to hand back to you? When we want to take a break for 10 minutes or so, and then I'll hand back to you for GDP?
That's all I've got for you guys.
Yeah, let's do that. Let's take
Cool.
a 10-minute break.
So I offered to unmute everyone. Since we were sort of taking a break, people want to a chance to say something? Just be aware that when our meeting restarts, we'll be remuting just to keep the meeting flowing, okay?
It does. No, is it?
I see Dr. Fritz.
Yeah. Hey, just I wanted to go back to that last question because I think the part that is, are you able to hear me?
I can hear you. I'm not
Okay.
sure our two presenters are here.
Oh, okay. Because this was for Peter. Or it's Peter, right, Dooley?
Well, I'm already editing sketch, but I'm not in.
I'm Christine.
David, Chris.
Two sketches.
Oh, David Dooley. Okay. Sorry.
David Donnie.
I mean, I suppose I could open different
Okay.
PDFs. Yeah, but you can open multiple files. Sketch that part. Yeah. And when you edit, when you need to open a second sketch, person still thinks it's editing. It's really dangerous.
Well, while you're waiting, you could just ask, what was your question?
Well, okay, so the question was, does looking at real, it's just I'm getting a lot of background noise, so it's hard for me to.
Anyway, that's hardly, that's not achievable. So.
Are you guys not hearing that?
For the finished thing.
I'll mute. I'm probably generating.
Okay. So
That better,
So
Chris?
my, yeah, it is. Yeah,
Okay.
sorry. I'm in my car, so I'm not able to
That's okay.
maneuver like normally. Debbie, is it possible for you just to read the whole question? Because it would be easier just to read it because I can't look down and drive. The question that I put in the chat, because you had read the first part of it, but I think the second part of it was really what I was
Right. And
had a
David and Carl are away right now, so I don't know if you want to wait till they get back.
Oh, okay. Okay, because I see Carl on screen. He looks like he's
Oh,
looking.
yeah. Let's
Go
see.
ahead.
Yeah,
I'm eating a chocolate, some ice
Oh,
cream.
there you
So
go.
I'll
And I
feel
see
better
David
after
too.
this. I'm about to
All
get
right.
burned, so I'll need this ice cream.
So
I see
David,
yeah.
I'm the one that had the question, and Debbie read a portion of it, but I think the second half of it is really what I wanted to kind of talk about. And then I also had a comment just about credit card debt. But Debbie, can you
Yeah.
read it just so he can, and then I'll expand on it if I need to?
Sure. Hold on, Chris. Give me a moment.
Okay.
Okay. Well, I know I asked the question, David. So basically it pertained to the real wages and inflation. To determine affordability. So the rest of it is real wage statistics are averages, and they don't fully capture cumulative price increases in essentials like housing, insurance, food, debt costs, and regional affordability. Inflation may have cooled, but many households are still living with permanently higher baseline expenses and depleted savings. And the comment about people still buying and having multiple TVs, etc., credit card spending is at record highs, so that can't be a good thing for a household. For credit card oligarchs, it's probably a great thing.
No, I mean this
Yeah.
Dr. Chris is correct on a lot of these things. I mean, there are people that are left behind. We are giving you the real wages overall, and I also gave you that CBO information. And so when I look at the CBO stuff, that's the most credible and impactful analysis that we have. Now, again, it doesn't mean that there aren't people in the bottom 20% that are suffering, or even in the middle of that distribution that are suffering. Everybody's situation is going to be different. It's just saying the economy overall, not just overall averages, but the quintiles, the groups, the quintile is 20% of the population. Even at the quintile level, we're better off than we were in 2019. Now, if you thought 2019 was also bad, then that's different. But affordability was not a brand name thing. It wasn't the key word that people use now. And so it is difficult. And I think Dr. Chris brought this up some time ago as well, that there is a study, and I remember this from a couple of years ago, that said that if you include interest costs and other financing costs, and that makes it clear that households are having a lot more difficulty. It sort of adds to the officially reported inflation numbers. The problem with that analysis is it doesn't include the asset side, the appreciation of houses, the increase in the stock market. A lot of people don't have a lot of money in the stock market, but they have some. They have a 401k, and the 401ks have doubled in the last 6 years or so. So if you are going to add cost, you also have to look at if you're going to add those financing costs, you have to also add the asset side, which is where that's why the government doesn't do that in the CPI numbers or the PCE inflation. That's why they leave it out, because you're starting to add a debt-sided a debt-related cost, but you're not talking about the asset side gains. And so that's why I haven't put it in here, but that is a study that exists that says that if you do add those costs, yeah, the things don't look as good. But regardless of the inflation measure you use, the officially reported inflation numbers, the wages have outgrown that. The other thing this is something that is a subtle point, and I haven't done the math on this in a while, but bear with me because it's kind of complicated. The wage is applied to your gross income, meaning a wage gain, the number I showed you earlier. But inflation is applied to a subset of that number. Inflation is about the cost you spend. So that's after tax spending. So you have the gross, which is where the wage is applied, and then you have the inflation is applied to a after tax number. So whatever your disposable, whatever's left over after you pay taxes. And so if wages and inflation both go up the same amount, because wages applies to that bigger number, your gross income, you're actually ahead. And so when wages have outgrown inflation by a meaningful amount, you're really ahead. If you're lucky enough to have gotten those increases. And people that switch jobs got bigger increases than people that stay in their jobs. Again, different households are affected differently by inflation, as I gave you that quick example earlier of the rural renter versus the urban homeowner. But I'll stop there. Go ahead.
And David, I have another question from Jeannie, which may be something you could answer.
I'll try.
I bet you could.
She may not agree with, we might not have, we'll see.
She is basically asking, could you please explain in the simplest way possible, treating me like I have little to no background knowledge in economics, why the national debt is not a crucial issue?
It's not a problem. And understand, I could be wrong. And we've got a slide on this that if you've been in this meeting before, you have seen, which is the household net worth in the United States. The households in the United States, everybody's worth is about $175 trillion, and the national debt's around 40. 175 versus 40. So the U.S. is not going to go bankrupt anytime soon. If for some reason we were, let's pretend, even using a household analogy, we couldn't just print money. If we had to come up with money to pay our bondholders, they would take us to court and they would force us to raise taxes on rich people to pay them. Now, that's not going to happen in the U.S. because we can print money. We're not going to default. If we have an obligation, Uncle Sam can always pay it. You just have to pass the legislation. They will conjure the money and they will pay whatever obligation. So you can't go bankrupt in the sense that a household can go bankrupt. The risk you have is inflation. If the Fed or the government is printing a ton of money to pay off these obligations, then you could have inflation. And the question will then become, will the 99% vote to raise taxes on the top 1%? Or more realistically, will the 90% outvote the top 10% to get taxes raised? Or will they rather deal with inflation? And so if we ever have a debt crisis, inflation's going to start jumping, interest rates are going to start jumping, elections are going to come up, and the Democrats are going to say, we're going to raise taxes on rich people and deal with this problem. And the Republicans will not do that. They will say, we are going to cut Social Security and we are going to cut Medicare. And I would love to be running for office under those conditions. So there is, if we get to a crisis point, which we're probably not, but if we did, there is plenty of money out there to raise taxes on the rich. And I didn't say this, but it's in the graph. We'll show you in a little bit. The top 10% have 125 or 120 of that 175. So you don't even have to tax the bottom 90% to pay this stuff off. You can tax the top 10% and they got 3 times the national debt in the value. And you're not going to necessarily take that money out of their wealth. You're not going to force them to sell their stock portfolios, but they get an insane amount of money in tax breaks every year. About $1 trillion. The top 20% get about $1 trillion in discounts off paying the table rates, the income tax table rates. You could get rid of that. You can raise rates on them. You can remove the cap on the payroll tax. There's a million cool ways that you can raise taxes on just rich people to handle the deficit or any other issues we run into. So that's why I don't worry about it. Now, it would cause a lot of drama. It would make some interesting news. But the fact is, the rich have the money. They got plenty. 4 times the national debt in terms of household net worth, almost 5 times overall. And when we show you the graphic, it'll be even easier to see it. But that's the simple version, is the rich people have us covered. If you want to boil all that down to one sentence, the rich have us covered when the time comes, and the many can vote to raise taxes on the few.
Right. And while you're on a roll, David, while you're on a roll, Doug is asking, are we going to have stagflation?
Definitely a possibility, but not like you'd have in the 1970s, I don't think. It's possible, though. I mean, what's kind of rescuing things right now is this giant investment that businesses are doing in AI. And if you take that away, it'll be interesting to see if we get the stag part. If, for example, AI doesn't work, or these companies just stop investing in it and just say, well, we're not going any further. If that were to happen, which is unlikely, but if it were, then you could see, I think, the stag part, and we already have the inflation part. It's not 10%, it's 3.8, but it could be 5 before this is over. And if we don't, kind of stop doing dumb things with tariffs and unnecessary attacks on sovereign nations, then we'll be able to get away from that. But definitely it's a risk. I think it's not going to be like what people thought about in the 1970s, where it was really severe. It would be just moderately bad, I think.
That was actually the early 80s.
Early 80s, okay.
And we have a hand raise. Would you or Carl like to take that?
Well, let's hear the question, Anthony.
All right, let's see. Anthony, go ahead.
It's not a question, it's a statement. The other reason why the national debt is not a problem is because that is private sector savings. Somewhere between 2/3 and 3/4 of the national debt is owned by American citizens. So if you want to eliminate the national debt, you have to tell me where people are going to put 25 trillion in savings.
Yep.
Hmm.
It's mainly used as an excuse to scare people into cutting spending. Like Republicans always say, we have a spending problem, not a revenue problem. That is, I can make a better argument that we have a revenue problem, not a spending problem. I can argue better because spending has a better multiplier in GDP than tax cuts for rich people, meaning you get more bang for your buck by raising spending than you do cutting taxes for rich people. If you cut taxes for poor people, then you get more bang for that buck in terms of deficit going up amount. But we can say we have a revenue problem, not a spending problem, just as easily as they say the reverse. We don't, because Democrats don't do branding, and that's a bigger problem that we have. We need a marketing department. We need a marketing department with an economist in it that just goes to town. Like Mark Zandi is out there trying to help us. And so is the guy from MSNBC, Steve Ratner, does a great job with his charts on, what's the show called in the morning? Morning Joe. He does a superb job of explaining economic stuff in plain language with great charts, and he puts them on Twitter. We share them here from time to time. And it's just we need to learn how to brand and sell. And we've got some people that are good at it, like Buttigieg is really good at it. And I would love to have him as our head of marketing / communications. And let's get him out there doing this stuff officially, and I'll get the DNC organized. They seem completely helpless right now. And we really need to do better. And so marketing department, economist on the marketing team doing the charts, get Steve Ratner to help, have him consult on some of this, but start selling the competitive storyline. As Anthony just mentioned, national debt are the assets of the private sector. You don't hear people say, when people say we've got a budget deficit and everybody's supposed to be scared, like, whoa, it's $2 trillion. Whoa. But they don't say is that's a private sector surplus. The private sector is getting richer by $2 trillion when the government runs a $2 trillion deficit. Who is receiving all those interest payments the federal government is spending? The bondholders, the private sector. Now, it's rich people that own most of the bonds and assets, and so we need to tax them. But it is not that the national debt is evil or that it's destroying the economy. That's all baloney that conservatives have gotten a lot of people to believe it, but they always say they want you to be scared about spending, they never want to talk about raising taxes on rich people. You almost never see that. A modern deficit hawk is a true deficit hawk. Raise the spending, raise the taxes, cut the spending. Those people they exist in what's the word? In dreams only. There are very few of those true deficit hawks out there.
Okay, looks like Jeannie raised her hand.
Yes, she did. Let me go to Jeannie. Hello, Jeannie.
I was just asking that because a young man who was a Democrat candidate was really getting into the weeds about the national debt. And I just said, please don't talk about that. I think he might have once been a Republican. But I for the first time, I really do understand what you've been trying to say for the last 10 or 12 months. I appreciate that. Thank you very much.
Yeah. And one thing we can do is I've got some notes here, or I will take some notes here, but I will try to put the national debt argument. We used to do this from time to time where we would put sort of like talking points into our presentation. Like how should Democrats talk about the national debt? And we would say, how do you make this argument and how do you counter the nonsense?
I would appreciate that. I truly would appreciate that.
Yeah, it's kind of a fun thing because we get to pretend to be Republicans. We do like role playing about be like, say, here's the crazy argument the Republicans make, and then here's the way to counter it with basic common sense and facts on the Democrat side.
Well, thank you, Jeannie.
Sure. All right, let's continue, Carl. Let's hold the questions for a bit. We can do it at the end, and then let's get back into the presentation, the GDP.
So gross domestic product is a measure of our national output of the size of the economy. Gross domestic income is a measure of national income and over time will roughly equal GDP. The Bureau of Economic Analysis in the Commerce Department reports GDP quarterly. It then adjusts the figure twice over the next 2 months. So the fourth quarter of 2025 was reported at the end of January, revised at the end of February, revised at the end of March. And then the first quarter of 2026 was reported at the end of April and will be revised again at the end of May and the end of June. And I think we'll cover those numbers, but GDP was not strong in the fourth quarter, but was at a 2% annualized rate in the first quarter of this year. And we'll see what happens, but my understanding is that war spending contributes to GDP, so GDP may not look bad. But this is what we have as GDP. And again, the scale is not based on zero. We have GDP, and these are all 2017 dollars. So it's bigger than this now. But GDP fell during the pandemic. By the end of the first quarter of 2021, it had regained its losses. It continued to go up and has continued to trend up over the last 4 or 5 years. So we get, and I did remember correctly, real GDP in the first quarter was a 2% annualized rate. The fourth quarter was a 0.5% annualized rate, but much higher than that in the second and third quarter, and it was negative in the first quarter of 2025. So we'll see what happens, and we'll see what happens with this. Do we have a stagnant economy? You don't necessarily see it from this, and you definitely don't see it from the last 2 months of payroll job growth. And what is contributing to the GDP? We have consumer spending, investment, government spending, and then exports minus imports. And here's the different pieces.
Let me mention something on this, Carl. The non-residential is business investment, and the structures right underneath that, so that's row 10 is structures, was actually down. And think of that as the walls of a data center. But underneath that, you've got equipment and you've got intellectual property products, and those were up huge, double digits, 13 and 17%. So the stuff that is going to be going into data centers and the investment in sort of the basic research and the things to build AI and create things like Chat GPT and other stuff, there's a ton of investing going on in that space, and it's growing very rapidly. So it's just interesting that structures has been falling for some time. I have to go back further to see if there was an even larger boom, but you would think that if they're going to build a lot of data centers, that structures number is going to move. It's not residential, it's non-residential. It's going to be in this structures number. So it's being driven by the stuff that's in the data center, and that's kind of interesting to me. It seems like we're missing a piece, right? It should be the structure should be going if all these data centers are actually getting built. All right, sorry, Carl, I'll stop there.
Okay. So Goldman Sachs is saying that the AI boom is not helping GDP because most of the goods are imported. Interesting. So it's saying all the stuff that we're putting into those data structures, those, is imported stuff. So it gets counted as a positive when it goes in, but it gets counted as a negative because it's an import. And what's happening with real GDP per job? Again, it's saying that real GDP is going up, although it went down a little bit under Biden, the GDP per job. But it's been climbing since, looks like, the start of 2023. So a lot of that growth predates AI. And 10 of our last 11 recessions started under Republican presidents. Um, I posted something on Facebook this past week, but basically, um, Americans are starting to understand that Republicans are not necessarily good for the economy. And this is sort of reinforcing that most of our recessions start under Republicans. Some, like Nixon and George W. Bush, got 2 recessions. And we'll see if Donald Trump will get a second recession in his second term to go with the pandemic recession. Measured from the start of Trump's term, most the indicators of whether or not we're in a recession have been growing. However, as we've talked about, a couple of the big ones are employment and jobs, and not so much in income, not so much. So the personal income, excluding transfer payments, has been going down, and transfer payments have been going down with a lot of the Republican cuts. So will we see something that gets declared a recession? If we continue to see an increase in payroll jobs like we've seen the last couple of months, probably not. If we go back to losing payroll jobs, we could well see a something that gets declared a recession, although it probably wouldn't be declared right away. With the exception of the pandemic recession, it usually takes months, if not a full year, before the National Bureau of Economic Research will call the beginning of a recession. So were there questions in the chat about recessions and GDP?
Do not see any at this time.
Okay.
Besides the first 2 that were in the very beginning that David had said they'd be answered, and I believe they were.
Okay. Well, I'm going to go ahead and stop sharing. Although did David just take over sharing?
Got it. Let me know
Okay.
if you can see the full screen, Carl.
I can, so that's
All
good.
right.
I was starting to stop sharing and I realized I couldn't do that anymore.
Uh-huh. All right. So the Congressional Budget Office does this awesome report every year where they go through the income inequality, and it's got a ton of great information in it. It's they do these presentations for the public, and they have the full report. This time they didn't do the full report. They did presentations for the public. I'll have to check that, to be honest. I did this one quickly, but they have this, and then they have the supplemental data, which if you're an accountant like me or Carl, you know how to use Excel. There's just a treasure trove of information in there that you can use, and I'm going to share some of that with you here. So the data, though, only goes through 2022. The reason is it takes them a long time to compile the IRS information on all these groups and get access to the data and then do their thing with it. So it usually lags a couple of years, but this is a brand new report that just came out in January. So, or new report that came out in January. So here is the share of household income that goes to the top 1%. So when you talk about income inequality, and this is after tax income. So this is back in 1979, that group had 7.4% of the income. And now they get 14.4% of the income. So almost double their share. Interestingly enough, this 14.4 is, let's see here, the exact same that the middle quintile has. So the top 1% has as much of the income as the middle quintile. So from the 40th to the 60th percentile, that that band right around the middle, that's how much income this group gets. It's 14.4, and it used to be 16.4. So, the rich getting more of the share and the poor getting less. So this is the size of the pie. If you think of this as a pie chart, each of the different groups, if they were all in here, this would be how big these shares are. So the question is, as I mentioned earlier about making things real in terms of per household, how much money are we talking about? What does this really mean? Because when you talk about inequality in general terms, it sounds bad, but nobody's like, well, what does that mean? And how much money is that? So I'm going to ask you to guess. Put the number in the chat that you think this costs a middle-class family in a year. Just guess that 2% of the income that they no longer get, that goes to the top 1% or other groups. How much do you think that is for the typical household in this group? Take a guess. And go ahead and throw it in the chat, and then we'll see how this group thinks about it. So just take a second and do that, and then I will show you what that is. Don't cheat and look at the presentation because you all have access to the thing. How much do you think this is costing a typical, a household in this range, that middle group household, that their income share has fallen by 2 percentage points? Another way of thinking about it is if they were getting 16.4 of the income today instead of 14.4, what is that 2%? What's 2% of all the income? All right, are you ready? Here's what it is. It's $12,000 per year, approximately, for a household. So it's $1,000 a month that rising inequality is costing the middle class family. So when you hear people talk about, I'm not a big fan of universal basic income, UBI, but if you were to give if you were to tax the rich and give $1,000 a month to the middle class, what you would be doing is essentially reversing the inequality worsening over the past, 79 to now is 50 years, 40 years? I can't do math. 46 years, 47. So and here's how the math works. I won't go through all of this. I'm going to ask you to trust me a little bit here, but basically you're saying how many households are there? How much income is there? And then how many households are there in that middle quintile? And it's about $318 billion that the group doesn't get. And there's 26 million households in that group. And it works out to $12,150 a year. So how close were we? I'm not looking at the chat, Carl. How close were people with their estimates? Who said $1 million or more? Come on.
We have Billions by Cheryl. We have 30,000
Okay.
by Morris,
Uh-huh.
3,000 by Colleen,
Okay.
and 2,000 by Lauren.
Okay.
That's what we got so far.
So my best estimate is 12,000. And that's per year, mind you. If you were to add that up over, the last 40 something years, and it wasn't all in the same year though, right? If you were to take the small amounts every year and add that up, then you'd see it. But, this 2% decline for that group cost them around $12,000 today. If they were getting 16.4% of the income, they'd be getting 12,000 more a year. It's a lot. So here's what's happened with the average federal tax rate. It used to be about 35.1% in 1979, and it fell a lot under Reagan, as you might imagine. And then Reagan said, whoops, we cut that too deep. Our deficit's going crazy. And so they started going back up. Clinton had raised taxes on the rich early in his administration, and it really started paying off in the middle of his admin. And then you had the Bush, not so much. There was also a peak in here because of the dot-com bubble. So there was a lot of capital gains that drove some of this, but not all of it. And then you got the Bush tax cuts in here in about 2000 and 2001. Drove that all the way down. Obama reversed it for the richest people. I think it was 2012 or 2013. I think that happened. And then Trump cut the taxes again. Are you noticing a pattern here? And then Biden didn't do anything, did not reverse the Trump tax cuts at all. So that didn't really change. Then now it's just jumped. This is also another capital gains jump. In 2022, the stock market really fell a lot, and a lot of people were selling, obviously, because that's how you get a big stock market drop. People are selling. And so they had to pay capital gains taxes, and that caused this number to spike. It's part of this spike here. It wasn't that somebody raised the tax rate. And so now, and over this entire period, it has averaged about 30 and a half, and if you kind of compare that to what it used to be 35, so the rich are paying about a 5% less effective tax rate than they did in 1979. And there is data going back further from Piketty and Saez. Gabriel Zuckman is another one. Zuckman, Piketty, Saez, those three guys are economists that study inequality. They've got data sets going all the way back to like 1913. If you go to Gabriel Zuckman's, he's a professor. If you go to Zuckman's website, you will see pretty prominently on there a bunch of inequality articles, but you'll figure out the ones that are the inequality numbers going back, or there's a New York Times article on it recently. You can just search it. The AI could also give you this data set if you wanted to see what it's like going back, but clearly the rate was a lot higher going back into the 19 teens. This 35, I think, got closer to 50% if you go back far enough. But at least for the time that the CBO does this, they always use 1979 as their starting year. They said that's the best year for comparable IRS data, that they feel comfortable using it. They don't want to go back further, but you can get that Piketty-Saez Zuckman data going back even further. So that's kind of what's going on with the tax rates. They go up under Democrats, down under Republicans, and it's been seesawing for quite some time. There's a lot of text on this page, but I'm going to go back to kind of what I said earlier about CBO. There's a different CBO study that I was quoting before. This one only goes through 2022. The other one goes through 2023 and is just about inflation and income. But this says, over the period, income after transfers and taxes increased for all income groups. And that's 2019 to 2022. And it's all in real terms. This whole study CBO did is in real dollars, adjusted for inflation. And however, they're saying from 2019 to 2022, inequality got worse, meaning the rich got more share and the poor lost share in that short window. And you guys all have this presentation, so you can read all the other good stuff that's in there. And then this one, again, a reminder that it's all adjusted for inflation. For 1979 to 2022, income grew for everybody. And so you'll often hear things like wages have stagnated for 30 years, blah, blah, blah. That's not really true. Wages, they've gone in sort of like a big suspension bridge, kind of a, think Golden Gate Bridge kind of looking thing, where they were, wages kind of peaked in 1975, 74, and then they fell for a very long time until the Clinton era. And then they've been coming up, and now they're above. I think we regained the record level somewhere in like, I forget if it was under Biden or if it was under Obama, but we got back to that real wage record level, and then it's been beyond that since. So everybody's, at least from 1979 to now, everybody's doing way better. The numbers have gone up, but just remember there was this, it swings between this, this very high number in the 1970s, and then it fell for 30 years, and then it's been rising, and now is that second part of the Golden Gate suspension system there is up there. Let's see, and then income inequality, of course, got worse, as we showed earlier, that the top 1% share has been rising throughout that period, and other wealthier groups as well. And then the lower end of the spectrum has not seen this kind of, this increase. The wealth came out of the middle class, as I was showing you here. I'm not showing all the other parts of the distribution, but you can figure the bottom is going to look more like this, and the top is going to look more like this. So lots of cool stuff in this CBO study. I'm sorry I didn't catch it when it came out in January. I got to put a calendar reminder out there, but saw it recently, and it's just definitive information and really thoroughly researched and very well explained. you know, they really do explain it in about as good a way as you're going to see it. And they've got a ton of graphs out there. So the name of it is at the bottom, the distribution of household income in 2022. And it just came out this year in January. Here's the chart I was talking about earlier. Wealth inequality is way more pronounced than income inequality. It's much worse. And the top 10% have 120 trillion of the 175. As Anthony mentioned, this left side here, it has a lot of the treasury bonds in it. These are assets of the private sector. And here's the national debt. This is through the fourth quarter of 2025. So I think this number is now 40. But you know, the household net worth number continues to jump as well. I mean, the stock market has done very well in the last, since Trump started, 22% or so up. You know, if you were to take $1 trillion a year out of the top 10% and apply that to our deficit's about 2 trillion. So if you cut it in half, the rich would still get richer, meaning that top 10% group, their net worth grows more than $1 trillion a year. So you could really tax the heck out of that group. They'll be fine. The economy will not go to hell in a handbasket. And you could pay off a lot of you could get our deficit down quite considerably if you chose to do that. Also, you'll hear people making arguments about what they call generational equity. Like it's unfair that we're accumulating debt, but somehow the younger generations are going to be saddled with it. Reality is there's an inequality clearly, but if you pass the debt to the next generation, passing treasury bonds to the next generation, you are passing assets to them. The generation, it's not like the right side lives forever and the left side dies off. The assets, the national debt is on the left side of this, is in this bar. It's all the treasury bonds are in here in various places, mostly in the rich, but in different groups. And you couldn't do this mechanically. It would be obviously very disruptive for the economy. But what I try to use this graph to say is don't worry about the national debt. Don't worry about generational equity arguments. And if we ever got into the kinds of things that worry people, like an inflation debt spiral, or an inflation interest rate spiral, the pain that the bottom 90% are going to feel from that should translate into electing people that will raise taxes on the rich to at least reduce that deficit. Even if they don't give us more stuff, they will at least get that deficit under control. And so I don't lose a lot of sleep over national debt, other than just getting annoyed and trying to explain it to conservatives or Republicans that I fight with online. It's really, I wouldn't call it a top 50 issue, but people love to talk about it, mostly because the media tends to echo the conservative argument. So a couple of other items here at the end, and then we'll open it up for questions on any of these subjects. Someone had asked a question around U.S. aid. You know, how much damage is that doing to the world that we cut aid, or did Trump cut the U.S. aid? And so he cut about 90% of foreign aid contracts, or about $60 billion. And that could kill about 5 million kids, give or take a few 100,000 either way. All right, so if that matters to you, then you should be upset about this. That's a lot of kids. Now, I've said it before, I think this is a very racist electorate. Sadly, too many racists on the Democrat side too that swing over to Republican when they get animated about immigration or other issues. Most of these people that would die would be not white. They would be in Africa for the most part. And that's why I think Trump can get away with this, and it's not killing 5 million kids over till by 2030. You know, this is something that sadly too many Americans will shrug off. But you know, there's a study out there, and there's articles on it, and they're listed at the bottom. Also, they can't draw a precise line to it, but when this aid stopped coming, people got desperate. And so they turned to violence. And so there was a big surge in violence in Africa after we cut this aid. So not only do you have the kids being killed by neglecting them food, not giving them aid, but now you have desperate people killing each other because of scarce resources. And I think, you know, the white supremacist, racist types think this is fine. And there is way too many of those in this country. But this is a way of saying, you know, how far we have fallen as a country that we would let this happen to this many people. It's disgusting. And so I'm glad that the person asked the question. The sources are here. We're really doing a lot of harm by cutting that spending, and it's a terrible thing. When people talk about, are the households in crisis, back in 2009 and 10, household debt was about 100% of GDP. And this was because households were borrowing, and they were getting mortgages with very little down and getting 2 or 3 houses, speculating. And then when the housing bubble burst and the Great Recession happened, it wiped out the bottom 50% net worth in the United States. It went close to zero. And however, since then, that household debt level has fallen all the way down into the 60s. And so when I look at, is our US households on the brink of collapse, there was a much stronger argument to say that in 2010, right around this peak, than there is now. Now, we're not as low as we were in 1990 when it was around 60, but still, the households are in much better shape. The lingo you hear economists use is household balance sheets look pretty good. They do. We've had some delinquency rising recently. So if you look at these blue lines like credit cards, this is the delinquency 90 days or up. So this is really badly delinquent people that are probably not going to be able to spend. These numbers were rising in 2022, 23, 24, and then they sort of flattened toward the end of the Biden administration, and to now, credit card delinquency has been pretty flat for the last couple of years. Student loans, of course, have gone through the roof because now Trump is collecting on that. We had stopped collecting it, and that's why it went to zero. Now it's back up where it always was, or at least was for many years. Where we're at, autos, the green line, slightly rising, but pretty flat for the last couple of years. There was this increase in delinquency toward the end of the Biden administration. People probably overextended a little bit. They got the big help from all the stimulus checks, and maybe they spent a little bit more than they should have and got themselves in a little bit of trouble. But not shown on this page is when you look at the early delinquency. So they do a 30-day version of this chart. It actually ticked down for credit cards. Delinquency got better in the last quarter, and same thing for mortgages. So this is, you can think of this delinquency as elevated and high, but not going through the roof. It's not doing a student loan thing. So that's something to watch for. And here's the report. It's out of the Federal Reserve Bank of New York. So it's Fed data, Federal Reserve Bank. And it's called the Quarterly Report on Household Debt and Credit. So you can look in there and see how households are doing. They've got a lot of interesting information. Just beware when you hear somebody say, household debt is this large number, or national debt is $40 trillion. When you look at a number by itself, you really need to look at it as a ratio. Like this is a ratio. It's divided by GDP. How much should I be worried about it when I see $20 trillion household debt? Should I be scared? Well, I would have been a lot more scared if it looked like this, but it's not. So you've got to analyze data and ratios. So when you see a crazy number, just kind of don't get emotionally involved in it. Look at the context. Are they dividing by something? Is what I always tell people that I work with in the work setting is, are you looking at a ratio, and over time? So I mentioned Kyla Scanlon. She's an author, also an economist that does, she writes now for the New York Times sometimes, opinions, and she's, I've got her book here. I have not read it, but she has a nice social media presence. It's interesting to hear what she has to say. And she makes a great point, which I've highlighted here, because people are asking, why isn't the stock market going down a lot more? Like even Trump said, he figured that the closing of the Strait of Hormuz would cut the stock market by 20%. He was surprised that didn't happen. He probably shorted the market with some of his buddies and was upset that it didn't happen, but I digress. What she's saying is that there's a guarantee out there that the Fed will act to prevent the stock market from cratering like they've done on many occasions. She's also saying that the federal government will also run large stimulus programs if the economy gets into trouble, meaning there is this sort of safety net built under the markets. That safety net probably could be stronger for everyday citizens, but the stock market sure has a nice safety net. So when the stock market booms, the rich people are happy, and when the stock market craters, they've got a guarantee. It's a good deal for the rich people that have these stocks. So there's a lot of other text in here, but the article is at the bottom. Why the stock market makes no sense right now. I recommend reading it. That's really interesting. She's got a good, engaging writing style. And we're all missing Paul Krugman writing for the New York Times, although you can catch his Substack has a lot of the same kind of information that he used to do. But she's a good economics writer, and take a look at what she has to say. One thing they also mentioned here is kind of one of the people she was talking about was what's a responsible way to administer AI? Like what kinds of arguments should we put in on this? If these big companies, the Mag 7, Alphabet, which is Google, Microsoft, Meta, Amazon, if they're spending $700 billion this year alone on AI infrastructure, a 60% increase, are they getting themselves into trouble? We'll see, but the idea here is that there's probably an AI guarantee, meaning they're right now helping the big companies get their data centers built in many places, giving them tax breaks, that the states are giving them tax breaks. But the government will probably bail out AI. And they use the term the AI put. It's sort of a way of saying that there's a floor under this. So again, an interesting idea that if you think the AI is that hand is being overplayed and it's overstated, then understand that the government will probably find a way to bail out these giant firms if needed. And again, the stock ownership is very highly concentrated. The top 1% have 47% of the stock market. The next 9 have 40. So 87% of the stock market value is owned by the top 10%. The bottom 50% has barely any, and the next 40% has very little. So the bottom 50%, when you talk about the net worth of the bottom 50%, it's usually talking about housing and other assets, like included in the net worth numbers that the Fed does is like the your appliances, your car. Not everybody's got a boat, but I mean, if you had one, that would be in there. Those are the kinds of things that are in there. It's housing and other assets in the home and the car. Of course, net worth, so minus any liabilities, student loans, mortgage on the house, that kind of thing. So Wall Street is not Main Street. Bailing them out is bailing out the rich. It is not bailing out the poor, because the poor, it's not that much of their money. We haven't been going into the deficit in great detail. We usually do that more annually now, again, because also we don't lose sleep over it. But just so you know, through first half of the fiscal year, the budget deficit is just slightly lower than last year. Still a very high number. Considering the economy is in pretty good shape, this is a crazy high deficit number for an economy that's in this good a shape. It should be a lot lower. That's what happens when you cut taxes. Biden didn't reverse the original Trump taxes, and so we're seeing the receipts would be a lot higher if we had, but they're already pretty good because the economy is doing well. This is one of the ways to see how the economy is doing is how are the tax revenues, and they're looking pretty good. So again, it's about the same as last year. The budget deficit it's just slightly lower. It's not going through the roof. And then we have some stuff back here about how you can donate or look at different sites to participate in different things. So, and then there are some resources that you can look at, some good articles that you can review that are out there. So we will stop there with the official stuff. And you don't have this slide, but if you were curious, let me just cover this briefly. I just pulled this together, I think last night, but the kind of what's the tariff situation right now? Like what's active, what's not? So the SCOTUS terminated these IEEPA tariffs, that authority, and the government owes that 130 to 175 billion back to people, and they're starting to pay some of that. And just mind you, Trump has been saying all along that these weren't paid by Americans. But at the same time, his government is paying back all the Americans that paid it. So, Trump is not credible, as you all know.
The American corporations that paid it in general.
So yeah, corporations and that's right. And if you are, and we'll see if this happens, if you paid a particular tariff, like to a transportation company, then they should be able to refund that directly to you. But yes, we will not be refunded as consumers, unless, like Walmart, I heard something about Walmart's talking about how can they, rebate some of their customers. You may see some heroic stuff being done by companies, but for the most part, we're not going to get this money back as individuals. Let's see, and the higher prices are there forever. So it's a gift that'll keep on giving. So what Trump is basically doing is all these other authorities, he's figuring out ways to sort of shift all this money into other kinds of tariffs. And he'll probably get away with it over time. It's going to be really hard for the courts to keep up with whack-a-mole of all the different ways that he's looking at the tariffs. And some are still fully enforced, like the Section 301 on China, that's still there. So this is just, if you have a screenshot capability, you can grab this, or I'll put it in the chat in a minute here. But while we're doing the Q&A, I just wanted you to see this, that I would not look for significant relief on the tariffs, even though the SCOTUS got rid of Trump's largest bucket, because he will find ways to hit us with tariffs if he chooses to do that. So let me stop sharing, and I will put that slide into the chat, and then we can go to any questions people have.
Okay. Well, David, I will tell you, it's more like the gift that keeps on taking instead of giving.
Well put.
Yeah.
That's a much better way to say it. That is a much better way to say it.
So we do have a question from Mark that was posted shortly after we resumed after the break. And he put in here that Iowa actually lowered their minimum wage I'm going to say 4 to 5 years ago. How does that figure into their economy, et cetera?
I don't have a good answer for that. That's I'd have to look into that. What I will say, when CBO has done a couple of studies on the effect of the minimum wage, and usually it annoys the results annoy liberals and make conservatives slightly happy. Just so you know, CBO generally, by reporting the facts, usually supports the liberal position, but this one they go the other way. That Krugman and others would criticize them for it. What they said was that when you raise the minimum wage, it will definitely help with income inequality, and it gives more money to poor people, as you would expect, and they spend it. It helps the local economies typically, but there will be some increase in unemployment, that companies will automate some stuff, or they will not be able to afford paying, 10 workers $20. They used to pay them $10 an hour. Now they're paying 15. So they will have fewer workers, or they will hire fewer workers. And so that latter part, there's been some studies done by liberal economists saying that there is no effect on employment, that CBO is sort of quoting old studies, but CBO has not changed their position. They consider that to be the consensus, for the most part, of the literature, that if you raise the minimum wage, you will help people, but you will also hurt some people with higher unemployment. So I can't give you a specifics for that state, but if they lowered their minimum wage, you would see that operate in reverse. You would see income inequality get worse. You would see less money in the hands of the poorer people, and you would see businesses happy that they could get away with paying less, and they would probably hire a few more people than they would have otherwise. But I didn't see a particular study. I'm just saying, if you apply the CBO to that, that's what you would get.
Here's, I do not see any further questions for you, gentlemen.
Okay. Well, if people want to hang out and keep talking and just throw out questions, we can unmute everybody and have a free-for-all.
I just dropped that tariff slide at the bottom of the chat. So if you guys want it, you can copy it or download it. I think there's a little arrow that appears when you pass your mouse over it, and that allows you to download it. So have at it again, but it's AI generated, but I think it's very credible. In other words, I sort of spot check this, or I follow the news a lot, and I think that, the general idea that he's going to find a way to keep tariffing people is the takeaway from this. It isn't that, that we're all going to get massive relief because of the Supreme Court decision. Trump can find a way around it, and hopefully the Congress will at some point feel pressure going into the election to sort of lower costs for people and take steps. But I don't think it'll happen in Trump's second term. Maybe in Trump's third term, we'll be able to block him. No, I'm just kidding. I hope not. But it's not. We're not going to get a lot of relief in the next couple of years, most likely.
Bite your tongue there, David.
No, it kills me. It's painful to have this kind of stupidity at the top of our country, but it is what it is. But this is my theory on this, is that it is when you have a racist country and you tell them that the biggest crisis is the border and that it's being overrun by brown people, they will do stupid things like elect Trump. And we also have a lot of people that don't like the idea of a woman president. There's a lot of misogyny out there. And
Yes.
I hope that we think about that very carefully in terms of who our next candidate is. And the candidates that are out there think very carefully about whether they should be running for president. But I might not have the majority view on this call or others, but I think we have to be very aware of what kind of electorate we have. And, we have to react to that to some extent. And it's painful because the more immigrants you have, the better. Your economy is going to boom if you have a robust immigration. When you got an aging country like this, you're nuts to let your population shrink or your job creation to be flat. You really want to be a multicultural, what's the word I'm looking for? Not forgiving, but an integrating type culture. There's a word for it. Somebody shout it out.
Welcoming. I don't know.
Welcoming. So there's a word. Sorry.
This-
But that is what you want, and that is usually going to boost your economy more. Trump has sort of slowed the economy and slowed our incomes, and now he's straight out raising prices on people with the tariffs and the war. So
We have
it's just
diversity.
a lot of bad is happening.
David, we have diversity put in the chat.
Thank you. Yes.
There you go.
Good
old
old
D, yeah.
inclusive. Inclusive was the word I was
Inclusive,
struggling
yes,
for.
there we
That's
go.
the word. An inclusive, multicultural democracy is the strongest form you're going to get. And when you let racists have power, they do crazy stuff like Trump is doing. And
Yes.
the media seems happy to do that because they are very concerned about access and getting sued. And there's a lot of fear in the media right now. And I thought they did just an absolute injustice to the United States to say that the real crisis is the border security, as opposed to saying you need to get in as many immigrants as it takes to keep your economy going. And that we had 2 open jobs for every unemployed person. It was a perfect time to bring in a ton of immigrants, and Biden did the exact right thing. He did supply side economics almost perfectly timed to bring in all those people and put them to work. And that's what
Oh, David froze, Carl.
about the border crisis. And it's like,
Okay.
what crisis? You're like, bring me these immigrants, bring them. And the Democrats got scared. We didn't want to say that. We panicked a little bit, and,
There you go.
we got, fear doesn't help you when you got to confront these bullies.
You're now
I don't
unfrozen,
think that's the way
David.
to win elections.
That's a fair point. And that
But he does want to bring in the white Afrikaners.
which should not surprise people, right? I mean, based on the thesis I just threw out there, that is the MO of these people. So questions, do we have questions? I will be quiet for a while.
Oh, I do not see any at this moment. Would you like to take hand raises?
Sure.
If anybody has. Yeah, if anybody, there we go. Doug Day. Hello there, sir.
Hello. Well, I had posed a question. Could it not be argued that by raising the minimum wage and putting more dollars into the bottom of the economy, that money would speed and the velocity of dollar movement would accelerate, and that would create more jobs in the long run?
That is the liberal position that Krugman and others have, is that it's actually a win to do that. If you shift money from the rich to the poor, the economy will be better off for it. And CBO they're the ones that just kind of disagree with that, and they said that you would see higher unemployment. But again, like I said, the liberal economists did not like that, and there are studies out there that say exactly what you just said, Mark.
Well, further, you could probably make the argument that within 5 years, those dollars that went into the economy through minimum wage would end up in the pockets of the 1% anyway, after it had filtered and percolated through the economy for perhaps several years. It doesn't stand still. That money moves around.
Yeah.
Okay.
Okay. Mark, you have anything further to add there?
Well, yeah, I could tell a further story about my daughter's experience working. She went to Augustana College over in Quad Cities, and stayed around in one summer to work, and found a job over in Bettendorf across the river at a hardware store. But she told him, she said, if you want to hire me, you have to pay me the Illinois wage, which they did. And so she spent the summer working for them, and she discovered, the other people there who worked for a lowered minimum wage, how difficult it was for them to try to work 40 hours a week on that kind of money and run a family. And it really had an effect on her. And then she had a positive experience working for the LL Bean company here, the South Barrington store. She went in and interviewed, and she says, well, I'll be away at school. And they said, we don't care. You can work here when you're home on break. And the full-timers, she's a wonderful kid, and everybody likes her. And so the full-timers there saw what she was like, and so they said, oh, keep her. So whenever she came home on break, they put her to work. And it's interesting to see how sort of progressive attitudes in companies have a positive effect on certain people and other things not. Now, Iowa's starting to turn around, I think, because I think we have a good chance to pick up the governorship and maybe a Senate seat in Iowa. And I hope they get them going back in a better way, because Iowa didn't used to be like this. It's being more like Mississippi these days, and it's not good.
Wow.
And all the young kids are leaving. So that's my 3 cents.
Inflation, 5 cents, right?
Yeah. Yeah.
Okay. Thank you, Mark. Well, that seems to be about it, David and Carl. I don't see any questions and no further hand raises.
Awesome. All right.
Okay. Well,
Carl,
thank you,
what are the
everybody,
honors?
for coming.
Yeah.
I appreciate your comments, your questions. And we'll try and get things together for next month. And hopefully we'll have a decent economy over the next month.
All right.
Thanks, guys. Have a great night.
Oh, Mark put his hand up again. Do we take him
Well,
before
just
we leave?
Had a one promo for a week from tonight is our climate change meeting, and we're discussing data center legislation for the state of Illinois and where it currently stands. So I'm hoping a lot of you can attend. Thanks.
Okay.
All right.
Good night, everybody.
Good night.
Good night.